thanks everyone for tuning in today. Really appreciate it. And I know we are supposed to initially do this last week, so thanks for the flexibility. The Walsh family had a little run-in with COVID for the last 10 days, so needed to reschedule that. So really appreciate that. But as Paige mentioned, I lead the financial planning team here at SoFi. So really that just helps give me a unique perspective with our planners talking to our members one-on-one on a day in and day out basis, seeing what they're talking about, different things like that. I do consider myself a pretty big nerd from a financial planning perspective. So love talking about this stuff. And if there's any questions that come up throughout, please let me know, and we'll try to make this as engaging and interactive as possible. Some quick, I guess, housekeeping items on my end before I hop into the content. I am a certified financial planner, but nothing I talk about today should be looked at like financial advice. Think about it more as high-level education, guidance, things like that. If you do want advice, then you can always schedule a call with one of our financial planners. It's complimentary member benefit for SoFi members. So really today, when it comes to investing basics, what we're going to do is we're really going to kind of break this down into 3 different parts and then leave plenty of time for questions at the end. So as those come up, drop them in the Q&A thing at the bottom of Zoom. But those 3 sections are really going to be, number one, like, I guess, looking at it from a behavior perspective. I think a lot of times when we interact with people one-on-one, they tend to jump right into investing. It's like, hey, what type of stocks should I buy? Or what type of different things should I be doing with my money? But a lot of times there's like underlying behaviors that it's just helpful to be aware of as you're, thinking through how to get started and ultimately become, a better investor. And then we'll transition to some really foundational concepts that I think are important for all investors to understand as they start figuring out why they're going to invest their money a certain way, how they're going to invest it, things along those lines. And then finally, we'll kind of bring it all together with saying, there's things that matter and there's things that don't matter when it comes to investing or really any financial topic. What are some of the most important things that we've seen as far as like developing healthy habits when it comes to investing as we kind of look to make the next step and move forward? And then we'll wrap up with questions. So we'll start off this first section with really kind of, I guess, the behavioral side of things and thinking through like, hey, what are some things that are standing in the way of most people not only getting started investing, but becoming better investors by and large? And really the motivation behind that is just experience talking to members, reading things related to how everyday investors do compared to like the broad market, for a prime example. So I mentioned we'll have some interactive action. I am not the most tech savvy person in the world, so we'll just do this old school style. So drop the letter in the chat. So I guess just a quick poll, if you think about like over the last like 20 years and you compare the average investor to what the market has done, and I mean, the market's a pretty general term. Do you think the average investor has done better, about the same, slightly worse, or way worse than what the market has done over the last 20 years? So feel free to drop it on into the chat. Oh, man, plugging away. We got a bunch of answers flowing in. All right. Survey says, which shows that I think that's Price is Right or something like that. Anyways, the answer is actually D, way worse. And I think this is why typically we start with this idea of like, okay, what are some things that stand in the way when people start investing and how they can just, start getting along the lines of the overall market. And if you look at the data, admittedly, there's a bunch of different research out there as far as like, how does the average person do compared to the market? One measure of that is saying, okay, over the course of the last 20 years, like high level inflation, I know it's much higher now, but over the last 20 years, inflation was a little bit over 2%. The average investor earned just under 3% a year. But on the flip side, the S&P 500, which is probably the most common representation when people say, hey, how's the market doing? Is it up? Is it down? Whatever it may be. Probably the most common representation is the S&P 500, which is the 500 largest companies in the US, actually earned about 7.5% a year. So the average investor actually earned less than half of what the market did over a 20-year period of time. And I saw a comment in the chat, this does not mean that you should not invest. I think what it does mean is I think it's about creating awareness and thinking through like, hey, why did that happen? And how can I prevent that from happening to me? And I think a major reason why that happens and why the average investor ends up earning less than half of what the overall market does is just as simple as human behavior and the way our brains are wired just get in the way and cause us to be in that group. And, full disclosure, I am a financial planning nerd. Like this is all I've ever done for a living since, for the last like 17 years, 16 years. And I'm still subject to a lot of this. So I think it impacts everyone, and that's why it's important to kind of be aware of it. So some of the common things that we tend to see get in the way and cause this big difference are different, like kind of biases that we naturally have and impact, when we look at our investments or emotionally how we respond to, seeing our investments going up or down or picking how we're going to invest our money. The first bias would be loss aversion. At the end of the day, humans and people in general, they naturally feel more pain with the same size loss as they do with the amount of joy that they get from the same size gains. So like if you lose, let's say $500, you're going to feel significantly more pain emotionally, and it's going to cause more stress and more anxiety than the amount of joy that you get if your account went up $500. So that's something to keep in mind, especially as we kind of get into this environment where everything's in the palm of our hand. We go on our app, whether you use SoFi or use any other app, and you see like front and center, like, hey, here's my gains or my losses for the day. Just keep in mind that when you see a red number, naturally you're going to feel much more pain for the same amount of money as if that was a green number, the amount of joy that you'd receive. So that's one of the key drivers on why people underperform the market, because feeling that pain leads them to making decisions that probably are not in their best interest over the long term. The other thing that really kind of comes into play, especially interacting with investors, I'd say over the course of the pandemic, since people have been at home more, a lot more people have been investing just based on my experience. And there's just been a ton of news going on, is this concept called hindsight bias. So in addition to loss aversion, hindsight bias is essentially like this idea that like when you look back, we naturally feel like we should have been able to connect these completely unpredictable events. And we end up beating ourselves up over it. And then it ends up kind of skewing our future decisions when we're making decisions on, whether or not we should keep investing or how we keep investing or things like that. And I use these headlines as an example, and I know they're a little bit dated from the start of the pandemic, but like if you kind of go back, it's like, a couple months before really the pandemic like really took hold here in the US, like there was these headlines and then on CNBC that's like, hey, red lights flashing, coronavirus outbreak. And then when we look at it with hindsight bias, it's like, oh man, why didn't I reposition my portfolio? That was dumb. So then the next time I see a headline, then I'm going to be more likely to actually act on a whim and maybe sell or buy or make trades that, again, probably are not in my best interest. The third one, I guess, from a similar perspective to hindsight bias, is naturally we have what's called confirmation bias. So it's essentially like we're going to seek out information that really reinforces or supports what we believe anyways. And especially in the media environment that we live in now with, I guess, general traditional media, social media, stuff like that, really you can find support to, I guess, confirm any belief that you have. Like if you look at it, this screenshot was taken from the very same day, from the very same website. And on one hand, it's like, hey, worst recession's coming. And then on the other hand, it's like, oh, hey, it's going to be better than expected. So depending on what your beliefs are, then people tend to kind of just read the headline or the information and then react based on that headline that really kind of confirms what they were, they ended up believing anyways. And typically the truth ends up somewhere in the middle. And then finally, from behavior perspective, and yes, this is a screenshot from my actual investing account for one of my positions. I can't say which one legally, but I mean, investing is about risk and return, but is going to be reference bias. So this is just the general idea that humans, I guess, they naturally kind of compare where their investment is at to a reference point. And typically that's going to be how much they actually paid for an investment. So think of like an individual stock. So in this example, I bought the stock when it was $370 a share. At the day that I took the screenshot in my app, it was at $155 a share. Naturally, like my brain is wired to like think, okay, that reference point's $370. This stock is worth $370, not $155. So it means I'm more likely to hold on to stocks that are down, and I'm more likely to sell stocks or investments that are up. So essentially it's the idea, like typically we act kind of counterintuitively because of this bias. Like we are more likely to sell winners and hold losers. And when you kind of combine all of these different things, like being, having a greater impact of losses on our overall mental well-being. When you think about, hindsight bias or confirmation bias or reference bias and all these different things, essentially what they do is they lead to skewed judgment. And that's really why we end up looking at, hey, how can we then educate ourselves and learn about the foundational aspects of investing and develop these healthy habits so we can get away from, our own human behavior, preventing us from earning, ideally what the market earns for a given level of risk, as opposed to less than half of what the market does. So now we'll transition to really looking at the basics or the foundational aspects when it comes to investing. And, throughout this, there'll be a lot of topics that we'll hit on throughout this that'll be, really the building block concepts. And I think it's important to kind of take and start with the building blocks and then kind of use that to kind of springboard into other aspects that you're interested in, whether it be, overall economic news or investment strategies or things like that. We have tons of different content in those areas. But really today we're going to focus on those foundational aspects so we could really start building from the ground up. And as we look at foundational aspects of investing, we'll kind of start with a couple quick questions. So I guess probably the easiest approach would be if you do a letter, comma, letter, or true, comma, false, or whatever it may be. So question number one, I want to get some feedback here. So in general, investments that are riskier tend to provide higher returns over time than investments with less risk. Is that true or false? And then number two, buying a single company stock usually provides a safer return than buying a stock mutual fund. True or false? All right, we got some responses flowing in here. All right. So survey says, in general, we're going to dive into this. This would be one of the earlier concepts that we dive into is the trade-off between risk and return. In general, investments that have a greater level of risk, or they fluctuate, they go up and down more, over time, they generally provide higher returns. So that's true. The other one, buying a single company stock usually provides a safer return than a stock mutual funds. That's false. And we'll get into why both of these are, those answers are the way they are. And there's always going to be exceptions. We're using kind of in general here. There could be specific stocks and things like that that are outliers. So as we kind of transition to, talking through the foundational aspects of investing, I think an important starting point is really talking about the most common investment options that are out there, really what they are, their pros, their cons, when to use them, when not to use them. because I think anything when it comes to investing, there typically is going to be a time and a place for different options out there. I don't think there's any extreme views across the board, like something is always good or something is always bad. It's about understanding and appreciating what something is and then using it for what it's good at and then avoiding what it's bad at. So the first one would be cash. And I lump cash in as an investment option or investment vehicle because, there are ways to invest in cash. And cash is essentially, it could be physical cash. It could be cash in, like, let's say a checking, a savings account. It could be, a money market account. It could be a certificate deposit, stuff like that. Essentially, the pros of cash and the benefits of cash are that it is stable. It is going to be relatively stable, and it is liquid. So it's essentially, it is going to be there when you need it. The cons of cash is, if you just look at interest rates these days, generally speaking, if you're talking about over the long term, cash does not provide a compelling rate of return. So, typically, especially, over the last, let's say 5, 10, 15 years, the growth of cash, even if it's in like a money market account, or if it's in a high yield savings account, has not even kept pace with inflation. So essentially you're losing purchasing power. So that's a con, especially, leaving money somewhere like that for a long period of time. So cash, liquid, and stability. Downside, it's not going to have very, very good growth over the long term. Moving on to bonds. So you'll hear the term bonds, maybe fixed income, stuff like that. At the end of the day, it's when you loan a company or a government agency or something on those lines, when you loan them money. It's kind of like when I, loan a friend money, where it's like, hey, you can borrow $100, you're going to pay me back $100 in a year. And on top of that, you're going to pay some interest along the way. Ironically, I've never actually charged friends interest, but maybe I should start doing that. But when it comes to bonds, really the pros from a bond perspective is they are going to provide some level of predictability. They still have a certain level of risk, like if the company or the government or the agency, goes under or defaults, there is some level of risk there. But the predictability comes from the standpoint of you have a specific amount of money that you would get back, along with specific interest payments that you would accrue along the way. So they can provide a level, not as high of a level of stability as, let's say, cash, but more stability than, let's say, stocks. The downside would be there's going to be additional level of risk when you're talking about bonds or fixed income compared to cash. And the returns over the long term in general aren't going to be as high as other places that you could put money. Stocks is probably the thing that people are going to be, most familiar and most comfortable with. And that's where you actually take money, you invest in a company, and you own a small, tiny share of that company. So, I can't name specific companies, but you invest money in, ABC company, and you are, let's say, 0.0001% owner of that company. The pros of stocks and investing in stocks are, really that over the long term, historically, they've provided the highest rate of return out of the options that we've talked about so far. So the money can, over the long term, grow at a higher rate. Really, some of the downsides when it comes to stocks is they tend to fluctuate much, much more than, let's say, cash or bonds, as companies do good, as companies do bad, as the economy does good, as the economy does bad. Heck, even just because of the sentiment that's out there across investors. So there could be, volatility for no particular reason. So it's really kind of a trade-off between those pros and those cons. Along the lines of cash, bonds, stocks, those types of things, we will get a lot of questions about mutual funds and ETFs. Really, they both operate in a very, very similar manner. From the standpoint of, you can put money into a mutual fund or an ETF, and what you're going to do is you're going to get, leverage from that. It'll allow you to invest, let's say $10, $20, $100. And rather than putting it all in one thing or one company, one bond, it's going to allow you to really kind of spread that out across dozens, hundreds, or even thousands of different investments. So it's a way to really access and expose yourself to many different investments with one decision. Also, they're going to be professionally run. And because they're professionally run, they can achieve economies of scale. So like, let's say a mutual fund could have an entire research team that helps pick and choose investments for, let's say, thousands or hundreds of thousands of investors. So that cost is kind of spread out rather than, let's say if you just hired someone on your own to just straight up manage your investments for you. There are some nuanced differences between mutual funds and ETFs. ETFs tend to be lower cost because they tend to kind of just track a specific aspect of the market, whereas mutual funds tend to be a little bit higher cost because they tend to, drift a little bit away from that and placing, more concentrated bets or positions outside of just how a specific aspect of the market is performing. Now, across all these different investment vehicles or investment options, really at the end of the day, investing is just truly a trade-off between risk and return. When people take on, a greater amount or a larger amount of risk, they expect a higher level of return to be compensated for that risk. So like the idea of like it going up and down and up and down, and the possibility of losing money, then in order to compensate for that and that, that risk and that the emotional aspect of it, they would expect higher returns. On the flip side, lower risk, lower return. And I think accepting this concept and appreciating this concept is kind of foundational to building out an investment strategy, because we don't want people to expect to have high return, low risk. Generally speaking, that would not happen. It's going to be, how do we balance the two? How much risk am I comfortable with? And then what's the return that I could really, go after or expect for the amount of risk that I'm ultimately comfortable in taking. But at the same time, it's not as simple as just risk return, because not all risk when it comes to investing is created equal. At a high level, you can kind of break down risk when it comes to investing into two buckets. There's going to be systematic risk and there's going to be unsystematic risk. And these can be kind of, nerdy concepts, and you can get super granular with all this stuff. But at the end of the day, systematic risk is going to be a risk that impacts a large part of the market. So think of political risk, maybe election uncertainty, and maybe governments in foreign countries, things like that. It could be like macroeconomic risks, in interest rate, inflation, currency. Some really common examples would be, let's say, inflation has been a major headline over the course of the last few months. That has an impact on a huge part of the market, not just one little area. COVID, another example, huge impact across the market. The flip side, we have unsystematic risk. And that's going to be risk that impacts a particular industry, a particular company, maybe a particular country. So some examples of that would be like business specific risks, like, hey, maybe the business isn't run appropriately, maybe they make some bad decisions. Industry risks, like let's say a common example of that would be the travel industry or the restaurant industry or things like that early on in the pandemic. Competitors, creditors, country, like let's say one country has something specific happen to it, then it would be generally maybe limited to that country, even though we are in a global economy. So why does this matter? Why does it matter that there's two different types of risks? And really it kind of boils down to the second question that led into this section of the idea of one individual company versus a bunch of different companies in a mutual fund. And it leads into the concept of diversification. I think diversification is something that is read about, talked about, and discussed on a regular basis. It's the general idea of, hey, diversification is good. You don't want to put all your eggs in one basket. But a lot of times people don't actually dive into like, why is diversification helpful and how does it work? And we kind of created this like simple visual to kind of think through diversification and how the benefits of diversification really manifest. So on the left-hand side, we think of a hypothetical scenario where you own one stock, and whatever stock that's going to be. When you own one stock, you're going to be exposed to systematic risk. So the risk that impacts everything, inflation being an example. But then on top of that, you're also going to be exposed to country-specific risk based on maybe where they're based out of, or where their clientele is based out of, where the revenue comes from. You're going to be exposed to industry-specific risk. Again, using like, let's say the airline industry or the hotel industry, stuff like that. You'll be exposed to specific risks that come from the business and how well they run that business. And then you'll also be exposed to some credit risk when they borrow money and things like that. But let's say you start having some diversification. So maybe you don't own one stock, maybe you own a handful. What you'll notice is you'll still have that same amount of systematic risk, but then assuming that these companies are different, like they're not all in the same country or the same industry or things like that. They differ a little bit. What'll start happening is that unsystematic risk starts reducing. So what you see is when you add some diversification, you end up reducing your overall risk, or how much it kind of goes up and down along those lines. And then if you achieved full diversification, let's say you mirrored how the entire global economy is, then you would just be left with systematic risk. And that's really the value and the benefit and the thought process behind diversification. Taking something where instead of putting all of your money in one individual company, no matter how good that company is, there's a lot of great companies out there, inherently exposes you to a greater level of risk because of the different types of risk than if you diversified across different countries, across different industries, across different companies within those industries, and that type of approach. The next thing that's important to keep in mind too is, I mentioned earlier when we were talking about the different vehicles or options with cash and bonds and stocks, and how they all have their time and their place. And I think a major part of that, and a major reason why we think that, is because if you look at those kind of broad buckets or classifications of investments, they perform much differently depending on the time period that you're looking at. So stocks over the long term, historically, they've had the highest return. But in the short term, that can vary quite a bit. So if you look at over the course of the last 70-ish years, the return of the S&P 500 has been from up 47% to down 39%, and anything in between. Bonds, on the flip side, that kind of narrows a little bit. The low end, -8%, and the high end, 43%. As you stretch out the time period that you're looking at, so let's say over a rolling 20-year period, that band essentially narrows. And really why that's important is because as we start thinking about what our approach should be, one of the key things that we end up, starting with is, when are we going to use the money? If we're going to use the money in the next year or even 3 years, the approach should be completely different than if we plan on using it 20, 30, 40 years from now, because of how spread out these bands are. If you're going to use it in a year, wouldn't want that money invested in stocks, because it could be a -39 year, it could be a +47 year, and it could be anything in between. And we don't really know which one it's going to be. And the fact is that no one knows over a given year. There's a lot of predictions, but generally speaking, those predictions end up being a little bit troubling when you actually kind of compare that to what actually happens. So now bringing it all together, like, hey, we started with some of the foundational aspects with behavior. thinking through how do we kind of set up our mindset and be aware of the things that get in the way of us, really kind of getting in line with what the market delivers, and then talk through some foundational aspects of different types of investments, the trade-off between risk and return, the value of diversification. As we work through initial conversations, someone comes to us to like, okay, how do we actually start investing money with people? We follow a pretty consistent process and focus on specific habits that I'm going to go through in the final section before transitioning to questions. So first, looking at, our last like survey question. So assuming you invested $10,000 and you earn 7% every year, which is the long-term historical inflation adjusted return in the market, how long would it take for your $10,000 to turn into $20,000? A, 5 years, B, 8 years, C, 10 years, or D, 15 years? So how long would it take for your 10 grand to turn into 20 grand, assuming you earned 7% a year? All right, survey says 10 years. And the reason why I talk about this is because there's I guess a rule of thumb out there where it's kind of the rule of 72, where it essentially says if you take 72 and divide it by your rate of return, that's how many years roughly it'll take for your money to double. And I think that's an important thing to keep in mind as we kind of set our expectations. Like, we don't want to, expect our money to, assuming it's invested in a diversified manner and things like that, to double every 2 or 3 years. We want to keep our expectations in line as we focus on developing these overall healthy and sound investing habits. So the first step that we typically talk through, and I know this is kind of awkward since this is investing 101 and it's focused on investing, but I think it is important to start by asking yourself, is investing the best thing that I could be doing with my money? I think investing is extremely powerful. It's absolutely critical if people want to achieve financial independence eventually to invest money. At the same time, that's not the best thing that everyone can do at any given time. There's going to be other actions that could be more important. And if that's the case, then we would encourage people to focus on those actions. So we created this framework that says, hey, go through this step by step. And if you're good to go on this step, move on to the next one. And this kind of essentially helps people figure out what their next money move could be. And it starts with a safety net. Step number one is making sure you have 1 month's worth of expenses in cash. If you're good there, move on to the next one. If not, then that would be the thing that we would focus on. Step two would be taking advantage of an employer match. It's free money, essentially. Step three would be protecting your income with disability insurance and or life insurance. Step four would be bad debt, like credit cards, personal loans, maybe some car loans, depending on the interest rate. Step five would be an emergency fund, which is 3 to 6 months worth of expenses. And then step six tends to be where we have a very, very strong focus on investing. And that's saving 15% of your income for retirement in order to be able to retire, living kind of the same lifestyle at a normal age. So as you can see, outside of like the employer match, investing tends to be behind some other critical things like an emergency fund or bad debt or protecting your income. So step one, find out if investing is the thing that you should be focusing on right now. Step two, I mentioned it earlier, it's figuring out and thinking about like, hey, what am I investing for? Sometimes this is going to be, investing for retirement. Sometimes it's going to be just general purpose. Sometimes it'll be something shorter term. We want to think about what we're investing for and when that's going to happen. And the reason for that is because we just take like a simple bucketing approach. If you're going to use the money in the next 3 years, our viewpoint is that should be in like a checking account, a savings account, money market, maybe a certificate of deposit, basically like that. It should not be invested because we don't have any certainty over what's going to happen in the market, whether it's going to be up, down, or the same over the course of a short period of time, like 0 to 3 years. 3 to 7 years ends up being kind of that intermediate timeline. Where it's not quite long enough where we could just kind of go at it It's not quite short enough where we need to take our foot completely off the gas, like the 0 to 3 bucket. And that tends to be a mixture of, let's say stocks and bonds, whether that's in, ETFs, mutual funds, or actually own like the individual stocks and bonds. Really, we're balancing the amount of ups and downs we're going to experience with still trying to earn a somewhat competitive rate of return. So it's really going to be a balancing act based on how comfortable you are with risk and everything else you have going on in your financial lives. And then bucket number 3 would be anything that's going to happen more than 7 years from now. And really, that's the long-term bucket where we care about the balance decades from now, not days from now. And that's where we typically focus on the long-term returns, where it's mostly going to be invested in stocks or funds that invest in stocks, taking a higher level of risk, dealing with more fluctuations and ups and downs to earn that higher return over a long period of time tends to be pretty important. Step number 3, after figuring out, hey, should I be investing? Yep, should be investing. Cool. Next thing is, what am I investing for? When's it going to happen? And then the third step is really focusing on, is investing a habit, and how do I make it a habit? A lot of times people will come to us with questions about particular stocks or investing in like sectors of the market, given what's going on with inflation or interest rates or whatever it may be. And those are all like powerful, interesting questions. But the thing that makes the biggest impact over the long term is making investing a habit. And starting as early as possible, assuming you don't have anything else better to focus on based on our framework. And then after that, making it that ongoing habit, so it just automatically happens. And I use this as an example, saying like, if someone made, 75 grand a year and they contributed 10% of their income, if they started when they were 28, by the time they were 65, they would have $1.2 million. If they delayed just 5 years, let's say they, lived it up for those 5 years, or whatever happened, and they waited till they're 33, they would only have $820,000. Now that's still a lot of money, but it's much, much less than if they started at 28. If they delayed another 5 years, they would have less than half, like 550 grand. So the power of compounding growth is really when people start early and they make it a habit. Compounding growth ends up making time their best friend, because really the growth grows on top of the growth, which grows on top of the growth. On the flip side, when people delay by a couple of years, 5 years, 10 years, especially anything longer, time ends up becoming their worst enemy, because they have to save much more money to get to the same place. So that's really the power of making investing a habit as early as possible and as consistently as possible. And then finally, as we're kind of crafting the investment strategy, is we want to make sure that as much money is going towards our goal as possible, which means being strategic and efficient in the amount of money we're spending on taxes and the amount of money that we're spending on fees. Taxes and fees are in people's control, unlike how the market does, which is not in people's control, and they have a huge impact over the long term. Unfortunately, a lot of fees, especially in the financial industry, are presented as like really small numbers. Like in this example, a 1% fee, like 1% sounds really small. But using that same example of someone who started at 28, 33, and 38, if they paid a 1% fee, they would end up paying anywhere between 80 grand and $250,000 in fees between when they started and age 65 with that 1% fee. So being as strategic and deliberate as possible in minimizing those fees can have a very big impact on how much money goes towards your goal, which that's what you're working towards, versus how much money goes to whatever financial professional or investment that ultimately you're working with. So really, that's where we kind of break down those habits. Is investing right? Okay. How should we be investing based on what I'm saving for and when I'm going to use the money? How do I make it a habit? Because starting that habit early and making it repeatable is so valuable. And then how do I keep fees in mind to minimize the fees and the taxes as much as possible? So wrapping up, I really appreciate everyone tuning in today and joining and dropping the good questions in here. Appreciate that. The recording is going to get sent out tomorrow, so be on the lookout. Paige is going to shoot out an email. If you want to get started investing, you can go to SoFi.com/invest, check out some content, watch list, you name it. Or if you want to talk to a planner, SoFi.com/SoFinancial. And you can schedule an appointment with a financial planner. It is complimentary for SoFi members. So again, thank you for everyone coming, and Paige will be shooting out an email tomorrow, and I think she just dropped in the chat. All right, have a good rest of the day.